The company vanished. How did this happen? Roughly $99 billion in market value vanished after a single corporate marriage. The risky decision was a stock-for-stock merger made at the peak of a market bubble. The clear consequence was collapse. In January 2000, America Online and Time Warner announced what executives called a merger of equals. The deal was valued at more than $350 billion on paper. Wall Street cheered. Magazine covers followed. Two very different companies were folded into one. The setup was simple and fragile. AOL rode a late 1990s tech boom. Its stock price had been driven far higher than its underlying cash flows. Time Warner controlled cable systems, film studios, and magazines. Time Warner brought revenue and legacy brands. The merger married inflated market value to entrenched industrial scale. The decision was a stock swap at market peak. The choice tied the fate of a legacy media house to the valuation of a high-flying internet company. The new board was dominated by the market's judgment. The balance of power shifted because AOL's stock granted it disproportionate control. That governance imbalance mattered far more than the press releases suggested. Momentum arrived fast. At first, the combined market cap looked enormous. Shareholders on both sides saw paper gains. Executives celebrated synergy forecasts. For a moment, the marriage seemed to validate the new media thesis. Distribution plus content would create unmatched reach and new revenue streams. Risk followed momentum. AOL's core business was dial-up access. Broadband adoption was rising. Monthly revenue per user for dial-up was under pressure. Integration costs began to mount. Accounting treatment placed large goodwill and intangible assets on the balance sheet because the deal was paid in stock. Those balance sheet items depended on future growth that the market was already beginning to doubt. Warning signs arrived in quarters. Early earnings missed optimistic projections. Integration costs outpaced expected cuts. Broadband churn and advertising slowdowns reduced the growth that justified AOL's valuation. Investors began to reprice the combined company. The inflated stock that had created control now fell, along with market confidence. Pressure escalated. Quarterly misses turned into larger shortfalls. Shareholder lawsuits were filed alleging misstatements and that management had overstated synergies. The company took multi-billion-dollar write-downs of intangible assets and goodwill. Each disclosure fed the sell-off. Market capitalization tumbled from the euphoric heights. Strategic options narrowed as the firm lost credibility. Stay with this story. The turning point was not a single press release. It was a string of decisions and reversals that revealed the mismatch between book value and economic reality. Large goodwill impairments acknowledged that past assumptions were wrong. Executive departures followed. The promise of quick synergies proved illusory. Creditors and investors began to demand clearer proof of earnings power. The firm could no longer borrow the benefit of doubt that once supported its valuation. Consequences mounted and grew more severe. Reported losses multiplied. Litigation and legal settlements consumed cash and management time. The company erased years of market value. Jobs were cut. Divisions were reorganized. Brand credibility eroded. The assets that had once been a fortress, cable franchises, film libraries, magazines, could not instantly make up for the decline in the internet business that had tipped governance and strategy. Human impact was stark. Mid-level managers lost roles. Long-term employees saw stock options collapse in value. Investment portfolios held by ordinary investors were damaged. Careers ended. Institutional reputations frayed. The pride of a storied media company was crushed under the combined weight of accounting write-downs, shrinking market cap, and public controversy. Institutional fallout followed. The board and the investor community rethought how stock-based control can mask economic fragility. Corporate governance debates intensified. Mergers paid in high-flying equity began to be scrutinized more closely. Lawyers and auditors spent years unpacking disclosures and valuations. Regulators and courts reviewed claims by shareholders who said the company had misled them about future cash flows and integration prospects. The forensic economics is clear. A smaller entity, valued by market sentiment rather than cash generation, seized governance and pushed strategy. Accounting rules allowed large, intangible values to be recorded, but those values required future profits that never arrived. When the market retested those assumptions, the balance sheet corrected through impairments and write-offs. Market value evaporated faster than corporate structures could adapt. The mismatch between who controlled decisions and who produced cash created pressure points that cascaded into collapse. Longer term, the event changed deal-making. Buyers and boards began to demand harder evidence for synergy claims. Valuations were tied more tightly to cash flows and less to market fads. Due diligence expanded to include cultural compatibility and revenue quality. The case became a cautionary template for why inflated stock should not be the sole lever of control. The chain from origin to aftermath is complete. A bubble-era valuation created unequal governance. A stock swap tied management and strategy to that valuation. Operational realities, technological change, declining RPU, integration complexity undermined the premise. Impairments and legal battles sealed the decline. The result was the loss of roughly $99 billion in market value, decades of corporate credibility, and careers undone. Learn the warning signs.